There's a dangerous moment in every market cycle. It's the moment when a story stops sounding like a possibility and starts sounding like certainty. And right now, that moment is forming around silver. If you scroll long enough, you'll see it everywhere. Silver is the smartest move of 2026. Silver is about to explode. Silver is the hedge, the trade, the insurance policy, the once-in-a-decade opportunity. And when enough voices repeat the same conclusion, your brain quietly shifts from analyzing to assuming. That's where discipline begins to fade. So today, instead of amplifying the noise, I want to slow everything down, because silver in 2026 is not a guaranteed win. It is a conditional thesis. And if you don't understand the conditions, you don't control the risk. You've probably seen the argument already. A new central bank chair is coming. Rate cuts are on the horizon. Election year incentives will lean toward easier policy. The U.S. has labeled silver a critical mineral. China may be tightening exports. Industrial demand tied to AI and electrification is accelerating. Supply is constrained. Gold already broke out. The gold-silver ratio says silver is next. Therefore, silver must surge. On the surface, it sounds clean, logical, almost inevitable. But markets rarely reward inevitability. They reward nuance. Before we go deeper, today is Monday, February 16th in New York. Policy expectations are fluid. Inflation is not runaway, but it is not gone. Growth is steady, but not unstoppable. That environment matters. Now let's build the thesis carefully. The bullish framework rests on several pillars. First, silver has no counterparty risk. Second, policy is likely to ease. Third, politics create incentives for stability. Fourth, silver's critical mineral designation could lead to government accumulation. Fifth, industrial demand is expanding. Sixth, supply growth is slow. Seventh, China could tighten flows. Eighth, gold leadership signals silver's turn. Ninth, the ratio suggests undervaluation. Those are the ingredients. But ingredients don't guarantee outcome. Start with the emotionally powerful one: no counterparty risk. If you physically hold silver, you are not dependent on a broker's solvency. You are not reliant on digital systems functioning during stress. You are not exposed to app outages or frozen accounts. You own the metal outright. That's real. That matters. But here's the missing piece. Eliminating counterparty risk does not eliminate all risk. Physical ownership introduces storage considerations. It introduces liquidity timing. It introduces bid-ask spreads. It introduces taxes depending on jurisdiction. It introduces shipping friction and the reality that converting metal into immediate cash can take time. None of those invalidate silver. They simply change the nature of the risk. So when someone says silver is perfect because it has no counterparty risk, what they are really saying is it removes one dependency. It does not remove planning. It does not remove discipline. It does not remove volatility. That's why precious metals function best as financial insurance. Insurance is not glamorous. It exists to provide resilience. You don't buy insurance expecting fireworks. You buy it to reduce vulnerability. Investments, by contrast, require thesis and timing awareness. I've accumulated through multiple cycles. I've watched silver get ignored. I've watched it get hyped. And I've seen investors struggle not because silver betrayed them, but because they attached unrealistic timelines to complex macro forces. Now let's focus on 2026. A major argument centers on central bank leadership. The current chair's term as chair ends in mid-May 2026. That date is real. There has been credible reporting about possible nominees. But here's the leap people make. New chair equals easier policy, equals rapid rate cuts, equals metals rally. That leap is not guaranteed. A new chair could be dovish. A new chair could be hawkish. Policy rates could decline while liquidity remains tight through balance sheet management. Rhetoric could soften while conditions remain restrictive. Leadership change does not equal automatic easing. As of the latest policy stance, rates remain in the mid-3% range. The message remains consistent. Inflation is being monitored and adjustments will occur when justified by data. That means rate cuts are possible, not certain. And even if cuts occur, context matters. If cuts happen because inflation cools gradually and growth remains stable, metals may respond modestly. Risk assets could benefit more. Real yields might remain firm. Currency stability might persist. Markets may already price in gradual easing. If cuts happen because something fractures, labor weakness, credit stress, recession, metals could initially decline alongside other assets. In liquidity events, investors sell what they can, not necessarily what they want to. So rate cuts are not a single direction lever. They are a response to conditions, and those conditions shape outcomes. Now let's talk politics. Election cycles create incentives for economic stability. Public perception matters. Policymakers become sensitive to visible economic strain. That's reasonable. But central banks cannot instantly lower grocery prices. And with inflation recently running closer to the low twos year over year rather than runaway territory, the narrative of spiraling inflation loses urgency. Sticky inflation is different from uncontrolled inflation. Policy reaction differs accordingly. That nuance matters for metals. Now we move to something concrete. Silver's inclusion on the U.S. critical minerals list in early November last year. That designation is official. It signals recognition that silver is strategically important for electrical systems, solar installations, and advanced electronics. But inclusion on a list does not automatically mean the government will aggressively stockpile in 2026. It does not guarantee strategic reserve purchases. It does not create instant shortages. It does signal acknowledgement. It highlights vulnerability in supply chains. It places silver within strategic conversation. Stockpiling, if it occurs, requires budget approval, political alignment, and justification. It is a process, not a shopping cart. Sometimes the more meaningful effect of critical designation is indirect. It can encourage domestic production discussions. It can influence permitting timelines. It can alter business risk assessments regarding supply chain security. Marginal shifts accumulate over time. Now consider industrial demand. Silver is not only a monetary metal, it is a working input. It is consumed in applications that do not immediately return supply to market. Solar capacity additions are projected to remain strong through 2026. Panels use silver even though manufacturers have reduced usage per unit. Volume growth matters. Electricity consumption is rising again, partly due to data centers, semiconductor fabrication, and battery manufacturing. Data centers may not consume large volumes of silver directly, but they depend on infrastructure, wiring, connectors, grid expansion that intensifies overall metal demand. When sectors become essential, redundancy increases. Backup systems, spare components, overbuilding, real-world engineering rarely operates at theoretical efficiency. The instinct that electrification supports silver demand is grounded in reality. The open questions are magnitude, timing, and whether expectations are already embedded in price. Markets anticipate, they rarely wait. And understanding that difference is where disciplined investing begins. Now let's move into supply, because this is where silver's structure becomes more complicated than most surface-level discussions admit. One of the strongest arguments supporting higher prices is that global demand has exceeded newly mined supply for multiple consecutive years. That is broadly consistent with available mining and industry data. A meaningful portion of silver production does not come from primary silver mines. It comes as a byproduct of mining for other metals, such as copper, lead, and zinc. That detail changes everything. If silver were primarily produced from standalone operations, rising prices would more directly incentivize expanded production. But when production depends heavily on the economics of other metals, silver supply becomes secondary to broader mining profitability. If copper prices weaken, expansion slows. If base metal projects are delayed, silver output tied to those projects slows as well. Supply cannot simply be flipped on because silver rallies. Mining is capital intensive. It requires permitting, infrastructure, financing, environmental compliance, labor, and time. Development cycles stretch years, not months. When investors say supply is tight, what they are really describing is structural inertia. Silver production does not pivot quickly. It behaves like a long steering arc rather than a quick turn. But this is also where language can exaggerate reality. The phrase multiple years of deficits often gets translated into we are running out. That translation is misleading. A deficit in annual supply and demand refers to flow imbalance during that period. It does not automatically mean above-ground inventories are exhausted. Imagine a restaurant that uses more ingredients each day than it receives from deliveries. That creates a daily deficit. Does the restaurant immediately shut down? Not if it has stored inventory, frozen reserves, alternative suppliers, or the ability to raise prices and reduce demand. Over time, sustained deficits create pressure, but the timeline matters. Silver markets operate similarly. Sustained deficits gradually tighten conditions. They reduce flexibility. They increase sensitivity to disruption, but they do not guarantee an overnight shortage. That nuance changes expectation management. A tightening market supports a bullish long-term thesis without requiring apocalyptic thinking. Now let's address price targets. Some projections circulating suggest dramatic moves, referencing historical spikes and implying triple-digit levels are within reach or inevitable. Price targets are psychologically powerful because they simplify complexity. They give the brain a destination, but markets rarely move in straight lines. Even during strong bull phases, silver has historically experienced sharp pullbacks, sudden reversals, and extended consolidations. Living through those swings feels very different than discussing them in hindsight. Late last year, silver reached new highs as easing expectations and supply narratives converged. Momentum accelerated quickly. But even within that strength, volatility remained present. That is normal behavior for this metal. Focusing exclusively on destination numbers without acknowledging path volatility creates fragile expectations. The journey matters as much as the endpoint. Now consider the gold leads, silver follows concept. Historically, gold often reacts first to macro uncertainty, currency dynamics, and shifts in central bank posture. Silver sometimes lags initially, then accelerates as speculative participation increases. But silver's industrial exposure complicates that relationship. When manufacturing slows, silver can underperform gold. When industrial expansion coincides with accommodative liquidity, silver can outperform sharply. Its dual identity creates variability. Central bank gold purchases remain elevated based on recent official reporting. That supports the broader precious metals narrative by signaling sovereign interest in reserve diversification. But central banks buy gold, not silver. Their activity shapes sentiment and macro tone, not direct silver demand. It creates backdrop, not timing. Then we encounter the geopolitical narrative summarized as China restricting exports. It is true that in recent years governments have increasingly used export controls and trade restrictions for strategic leverage. Supply chains have become geopolitical tools. That trend is real. However, broad, universally verified restrictions specifically targeting silver in the sweeping manner sometimes implied are less clear. The more realistic concern involves concentration risk. Refining and manufacturing capacity are not evenly distributed globally. When a major participant adjusts trade policy even modestly, flows shift. Premiums change regionally. Local shortages can appear even if global supply remains available. The risk is friction. Friction increases cost and uncertainty influences price before physical scarcity becomes extreme. Now let's revisit the gold-silver ratio. This metric compares how many ounces of silver equal 1 ounce of gold. When the ratio is elevated, silver is historically inexpensive relative to gold. When it compresses, silver tends to outperform. As a framework, it is useful. As a clock, it is unreliable. Ratios can remain stretched for extended periods. They can widen further before narrowing. They respond to gold's strength as much as silver weakness. During crisis periods, gold may surge independently while silver hesitates due to industrial exposure. Using the ratio as a directional compass rather than a precise timing tool produces more realistic expectations. If you are accumulating gradually and volatility tolerance is high, a high ratio may justify leaning slightly more towards silver, but that decision must reflect personal risk tolerance and liquidity planning, because silver's volatility is not abstract, it is felt. On a trading screen, price movement appears as digits. In physical markets, volatility translates into changing spreads and premiums. When spot prices rise rapidly, dealers may widen bid-ask spreads. When spot prices fall, physical holders may hesitate to sell, keeping premiums elevated. The physical and paper markets do not always behave identically in real time. If your strategy involves physical silver, your mindset must adjust. Your acquisition cost is not just spot. It includes premium and fees. Your potential sale price is not headline spot. It includes spread and liquidity conditions. Another overlooked factor involves capital cycles tied to industrial demand. Solar buildouts can surge when financing conditions are favorable and slow when borrowing costs rise. Electric vehicle adoption can accelerate with subsidies and moderate when consumer budgets tighten. Data center expansion can encounter grid limitations or regulatory hurdles. Industrial demand is real. It is not linear. The phrase "silver is always a good buy" requires context. Silver is not a savings account. It is not a fixed income instrument. It is not gold. It can underperform for years. It can trade sideways while other assets move. And then, when alignment occurs, it can move rapidly. That dual nature demands role clarity. Is silver insurance against systemic risk, a volatility-driven trading instrument, a long-term store of value outside financial intermediaries, a speculative breakout opportunity? Confusing these roles creates internal conflict when price action diverges from expectations. The 2026 narrative often bundles leadership change, potential rate adjustments, election cycle dynamics, critical mineral designation, electrification demand, and constrained supply into one cohesive projection. Some of those components are real, some are plausible, some remain conditional. A disciplined investor evaluates scenarios rather than guarantees. If rates decline gradually while growth stabilizes, silver could grind higher without spectacle. If economic stress emerges, silver could initially fall with broader markets before recovering as liquidity expands. If inflation remains persistent enough to sustain caution without spiraling, metals could remain relevant but not explosive. There are bearish possibilities as well. If industrial growth slows materially, silver's manufacturing exposure could weigh on performance. If real yields remain attractive, opportunity cost pressures could limit upside. If policy designation fails to translate into tangible action, enthusiasm could fade. Positioning amplifies risk. When expectations cluster heavily in one direction, even accurate long-term theses can experience short-term setbacks. Silver in 2026 is not destiny. It is probability shaped by policy, growth, supply dynamics, and human behavior. Understanding that distinction is what separates reaction from strategy. Execution is where most silver theses either succeed quietly or fail loudly, because having the right macro view does not automatically translate into the right personal outcome. Process bridges that gap. So instead of asking whether silver will rise in 2026, ask something more precise. What would have to be true for my strategy to work? That question forces discipline. If your purpose is insurance, then short-term price movement becomes secondary. The goal shifts toward gradual accumulation, secure storage, and ensuring that the rest of your financial life is liquid enough that you are never forced to sell metal under pressure. Insurance functions best when you are not emotionally dependent on it performing immediately. If your purpose is capturing upside from a breakout, then risk control becomes essential. Position sizing must reflect volatility tolerance. Entry timing must be deliberate. Exit rules must exist before momentum accelerates. Breakouts fail frequently. False starts are common. Without predefined limits, enthusiasm becomes exposure. If your purpose is currency diversification, then patience is required. Hedges often look unnecessary during stable periods. They may underperform other assets for extended stretches. That does not mean they are ineffective. It means their role is defensive rather than speculative. Clarity about role prevents emotional whiplash. The common mistake is assigning silver multiple jobs at once and reacting negatively when price action does not satisfy every expectation simultaneously. Allocation planning is the next critical step. Before adding exposure, define your maximum allocation, not your aspirational target, not the allocation you would hold if prices doubled, your maximum exposure based on risk tolerance, liquidity needs, and financial obligations. Once that ceiling is set, structure how you will enter. For most investors, incremental purchases reduce psychological strain. They smooth volatility. They minimize regret risk associated with large single entries. Lump sum positioning can work, but it requires strong conviction and emotional stability. Then define objective triggers for adding or pausing. A gold-silver ratio level, a percentage pullback, a fixed calendar schedule, something measurable. Writing those criteria down during calm conditions reduces reactive decisions later. Because once silver begins moving rapidly, cognitive bias intensifies. Anchoring bias appears. Round numbers become fixation points. Confident forecasts dominate attention. Social reinforcement increases. That environment amplifies impulsive behavior. The best buying opportunities often occur when enthusiasm is moderate, not euphoric. The best risk assessments happen before volatility accelerates, not during. Life stage considerations matter as well. Silver is bulky relative to gold. It occupies more storage space. It weighs more. Logistics matter over time. Younger investors with longer horizons and higher volatility tolerance may lean more heavily toward silver. Older investors may prefer gold's density and convenience. Neither approach is inherently superior. Context determines suitability. Some investors prefer measuring wealth in ounces rather than currency. That mindset can reduce emotional reaction to dollar fluctuations. It emphasizes tangible ownership. But real-world obligations, taxes, bills, emergencies, require currency liquidity. Ignoring that practical reality introduces risk. Balance psychological comfort with operational necessity. Now consider broader economic scenarios for 2026. In a soft landing environment, slowing but stable growth, gradually cooling inflation, measured policy easing, silver could appreciate steadily without dramatic spikes. Gains may be incremental rather than explosive. In a hard landing scenario, recession signals, credit stress, abrupt repricing, silver might initially decline alongside risk assets during liquidity scrambles before recovering as monetary accommodation expands. In a sticky inflation scenario, prices stabilizing but not fully normalizing, metals may remain structurally supported, but without extreme acceleration. Flexibility across these paths is essential. Rigid certainty rarely survives evolving data. There is also a credible bearish case. If industrial demand slows due to capital expenditure reductions, silver's manufacturing exposure could weigh on performance relative to gold. If real yields remain attractive, opportunity cost could limit upside. If the critical mineral designation fails to translate into meaningful purchasing or incentive programs, narrative momentum could fade. Crowded positioning compounds downside risk. When too many participants expect the same catalyst, even positive developments can trigger sell the news behavior. Markets often move in anticipation rather than reaction. By the time policy changes are formally announced, much of the price adjustment may already be reflected. Acting only when clarity arrives can mean entering after momentum builds. Acting prematurely can mean absorbing unnecessary volatility. Humility helps navigate that tension. Consistency also matters more than spectacle. Some investors highlight incoming shipments or sealed boxes as evidence of conviction. Transparency is not inherently problematic, but accumulation should reflect structured strategy, not emotional reinforcement. If promotional campaigns or giveaways are attached to silver discussions, separate marketing incentives from analytical reasoning, they do not validate the macro thesis. As you evaluate silver in 2026, ask yourself two direct questions. First, are you primarily seeking protection or appreciation? Second, what specific development would cause you to reassess? A shift in policy language? A sustained decline in industrial demand data? A change in real yield trajectory? Predefined reassessment criteria reduce emotional overreaction later. The broader narrative combines leadership transition timing, potential rate adjustments, election cycle incentives, critical mineral designation, electrification expansion, supply inertia, and ratio positioning. Each contains elements of truth. None alone guarantees outcome. Markets reward patience aligned with reality. They punish compressed certainty built on partial analysis. If silver aligns with your objectives, size exposure prudently. Account for storage and liquidity. Understand spreads and tax implications. Maintain diversification so no single catalyst determines financial stability. If silver does not align with your temperament or structure, forcing exposure because of persuasive commentary introduces unnecessary stress. Ultimately, silver is neither hero nor villain. It is an asset responding to policy, growth, supply, and sentiment. In 2026, those forces will interact dynamically. Price will reflect that interaction, not online consensus. Maintain perspective. Monitor developments calmly. Adjust deliberately rather than reactively. And remember the principle that tends to matter most in metals markets. Discipline compounds, excitement fades. Investors who navigate silver successfully are not those who predict every headline correctly. They are those who adhere to structured process despite uncertainty. Everything discussed here is for educational and general informational purposes only. It is not personalized financial advice. Individual financial circumstances differ. Before allocating capital, evaluate your own situation carefully or consult a qualified professional. Approach silver with preparation rather than impulse. Define your plan before volatility demands reaction. And measure success not by momentary price spikes, but by adherence to a strategy aligned with your goals and tolerance for risk.